Hi, I'm Jeremy Zuki, one of the financial planners with Abundo Wealth, and I'm here with our newest financial planner, DJ Jack. And we're super excited to have DJ on the team, and he's an expert in some really fun stuff like credit and travel that we love here at Abundo. So, DJ, I wonder if you could just start by telling everybody a little bit about yourself and how you got here to be a advice only financial planner.
Sure, sure. First of all, thank you very much for having me. I'm very happy to be here on this podcast and happy to be here at Abundo. The way that I got here is it's a long and winding road, but I will make it as succinct as possible. So, my major in college was actually audio engineering, and I was the guy behind the boards who would do the mixing. I'd set up the microphones. But long story short, I realized that's not a job you want to do forever. It's a lot of being locked away from the sun, a lot of really weird hours, really fun stories for sure. But I left that industry and found my way into tech sales. And doing tech sales was the first time in my life I had excess cash. Like I wasn't living paycheck to paycheck. And that inspired me to figure out what to do with this excess cash. So I started reading personal finance books. And the more I read, the more I started sharing with those around me. And I got a lot of really positive feedback. People were like, oh, tell me more about this. Tell me more about credit. Tell me more about that. And so I just kind of really got into it. I became that person within my friend circle and then at work. And it led me to it led me into the financial services industry, the financial planning industry. I was actually taking classes to get my CFP. I got hired on at a really prestigious firm, and I worked there for 11 and a half months. And then I left because while the firm was full of really great people, like awesome human beings, the business model always seemed flawed, or it seemed to maybe take advantage of people. So this was an assets under management business model where, the minimum account was $3 million and they were paying upwards of 1% for, management. So that's like $30,000 a year or more to do work that I was like, I don't know that this is, there's work being done. I just don't know if it's 30,000 plus dollars worth of work. Also, I wasn't serving the group of people that I wanted to be helping the most, which were people more like my family and people who struggled with, you know, finances. So I actually left and started coaching people for free on my own, just pro bono. I started like a little nonprofit just to help people with finances. And I left the CFP program because I was like, this is not an industry I want to go into. And I swore I would never get back into the industry until my good friend Lori told me about a place called Abundo. Lori is one of the planners here. She was employee number 4, I think. And she was telling me about the way it worked. And I was like, hold on. So there's just a flat rate. There's no earning commissions on this or, assets under management over. There's none of that. And she was like, no, it's just a flat rate. And I was like, that's a firm I could be a part of. And so when there was an opening, I threw my hat in the ring and here I am. So very happy to be here.
That's awesome, and we are glad you're here. And the other thing that I loved in your bio is that you're an entrepreneur of sorts. And so I wonder if you could maybe just talk a little bit about the travel company that you started.
Ah, yes. Okay. So I'm a huge travel hacking nerd. And I mean, I love points and miles. I love trying to figure out how to get to destinations as nicely as possible for as little as possible.
Mhm.
And I noticed a lot of people around me, they earned points, but they struggled to figure out how to use points. And it was such a struggle that they'd sometimes be like, I'll just take a cashback card. And I was like, no, you're leaving so much money on the table. So I started meeting with people who had trips planned, and I was like, let me help you figure out how to get where you're trying to go for as little as possible, right? And I was doing these meetings, and I realized I was like, I think I could replace myself with technology. So I started building a company called Vacay HQ that was designed to, help people figure out how to earn points and how to maximize those points. It has since morphed into something a little bit different, which hopefully you'll see more of in 2024. But yes, I through that experience, I mean, I've learned a lot of tips and tricks around travel hacking. So if you ever have any questions, feel free to reach out.
The connection there is that obviously with trying to get credit cards and build points, you have to have good credit to get a lot of the best cards that are out there. So that's really what we want to spend most of the time talking about is your expertise with credit. So maybe just like we're going to start at a very basic place. What is a credit score? You know, we get it talk people talk about it all the time. We hear about it all the time, but when that term comes up, what is that? What is someone's credit score?
A credit score is just a simple way for a bank or anyone else to know if you're quote unquote trustworthy with money or with credit. So you could take, there's a difference between a credit report and a credit score. Most people kind of think they're the same thing, but a credit report is just, it's like all of your accounts. It's whether you've been on time or late, how long you've had your credit. It's all of that stuff in one report, but there's not actually a score as part of that report. There are three companies that take that report and turn it into a score. They are Equifax, TransUnion, and Experian. Then there are two big companies that come along and take that report and reduce it into a score. So your credit report has no score on it. Then those two big companies are FICO and Vantage. But most people have heard of FICO, your FICO score. So they'll take your report, analyze it, and then come up with a credit score. And there's more than one credit score. There's a lot more than just one credit score. So if you're going for a house, there's a different type of credit score than if you're going for a car, than if you're going for some other type of loan. So FICO has all of these different scores behind the scene, but most people only know they're like one FICO credit score. And Vantage is a company that was created by the credit bureaus that also has their own score. So why would anybody use Vantage over FICO? FICO is definitely like the dominant player. It's because FICO is expensive to use. So if you want to pull somebody's FICO score, or if you're an app like Credit Karma, and you want to have access to people's FICO scores, that's going to cost a lot more money. So Vantage is basically free to the credit card companies. It's their own score. They are different though. So Vantage usually, your Vantage score looks higher than your FICO score. Yeah. So FICO is the one to trust. That's the one that the banks are going to pull when you need a loan.
And why is it good to have a good credit score? Why does it matter?
So having a good credit score is used in lots of different things. If you're going to go get a cell phone, they're going to look at your credit. If you're going to get your lights turned on, they're going to look at your credit. They can look at your credit when they're considering you for insurance, like all sorts of things that you wouldn't even think about. But the reality is your credit score does matter. It doesn't matter all the time. So some people will kind of really get stressed out and worried. Maybe their credit score dipped a little bit. But if you're not trying to make any credit moves, if you're not trying to get a loan, it's okay. You have time to repair your score and get it back to where you want it to be before you make the credit move. So it's not like if your credit score goes super low, somebody's going to knock at your door and evict you from your house or anything like that. But it does come up more often than you would think. Yeah.
And there are a lot of ways to improve your credit score if you're in that situation where you're looking for a loan, but some are more impactful than others. So maybe you could just talk a little bit about the biggest things that go into calculating that score.
Okay, so there are 5 main factors that affect your credit. Payment history is worth 35%. Credit utilization ratio is worth 30%. Credit history is worth 15%. Hard inquiries, aka new credit, that's worth 10%. And credit mix is worth 10%. So let's start with the ones people know. Okay, first, with 35% of your score is payment history. So, and of course, this is whether when the bill came due, did you pay on time or were you late? So, the interesting thing about this one is it's not like if you're a day late, it immediately gets reported to FICO. Usually you have to be over 30 days late. So don't stress out if you forgot. Just pay your bill as soon as you can. But that's payment history. Another one people are familiar with is new credit. Like when you apply for a new credit card, people ask like, oh, is that a hard inquiry? Because people know that if it's a hard inquiry, it's gonna ding their credit. But kind of a misconception about this one is that it's gonna ding your credit a lot. The truth is a hard inquiry only dings your credit maybe like 3, 5 points, somewhere in that range. So it's not a whole lot. And then after 6 months, it fades away. So it's nothing really to stress about. If you need to have your credit checked, it's okay. That's new credit, so people know about that. The other one people may have heard of is credit length. So your credit history. How long have you had credit? The average amount of time that is a good amount of time is 7 years, 7 years or more. And the way this part of the score works is they're going to they look at all of your different cards and all of your different types of credit and how long you've had it, and then they average them together. So it's just the average of all of your credit. This next one's worth 10%, which is credit mix. And credit mix are, what types of credit do you have? Do you have credit cards? Do you have home loans? Do you have car loans? Do you have student loans? Those are all different types of credit. The more types of credit you have, the better. But it does not mean you should go out and get a car loan just so you could have an additional, line of different additional type of credit. It's only worth 10% of your score. Pick up credit as you need it. Don't worry about trying to, do anything extra. Just get credit as you need it. It's not worth that much. Okay, now here's the big one. This is the one that most people don't know about it, but it has a huge effect on your score. It's called credit utilization ratio. And what this is, it's how much of your available credit you're using. So if you have $1,000 of available credit on your credit card and you're using $700, that's a 70% credit utilization ratio. If you have a 70% credit utilization ratio, that is going to hit your score really hard. Anything over 30% is a lot. And speaking of 30%, I didn't mention this. This is worth 30% of your score. So I'm using two 30s here, so I don't want it to get confusing. The same way payment history is worth 35% of your score and credit mix is worth 10% of your score. This is worth, credit utilization ratio is worth 30% of your score. Now, there's another 30 in there, which is if you're using more than 30% of your available credit, that's where you're going to see your credit score fall quite a bit. So the number that you want to be under is 30%, but even better is under 20%, and even better than that is under 10%. So your score will actually start going down once it gets over 10%. But if you're the type of person who pays your bill in full every month, this is something you never need to worry about. If you have $1,000 worth of credit, you use $1,000 on day 15 of the month, and you pay it off on day 30, then you're fine. It's essentially like using 0% of your credit. So those are the 5 factors of credit.
Got it. So if you build a long history, make your payments on time, and keep your utilization pretty low relative to the amount of credit you have, you're going to be doing well on the big three that drive the score.
Oh yeah, definitely. Yep.
Perfect. And there's one situation that comes up often because the credit card landscape changes so much that people get new credit cards and then stop using the old ones because they're no longer as valuable or whatever the reason is. And what do you recommend people do with old credit cards? Just knowing that payment history and the length of the history, is such an important building block of credit score.
Ooh, I love this question. So if you have a credit card that you've had since, it's your first credit card, you've had it for 10 plus years, you're like, it's a student credit card. It's not a good credit card. I just want to close it. I just want to start getting rid of credit cards. The worst thing you could do is close a really old credit card. So let's say you have a card that's 10 years old and you have a card that's, 1 year old, or 2 years old. So if you average them together, 10 plus 2 divided by 2 is 6 years. That's your average length of credit. But now let's say you get rid of your 10-year-old card and you just have your 2-year-old card, and that's going to drop your score. So keep your old cards open. But what if those cards are charging you an annual fee and you're like, it's an old card. I don't want this annual fee anymore. Almost always there's a credit card in that same family. So if you call the bank and tell them you'd like to downgrade your credit card to a card that has no annual fee, almost always they can do that and you'll be able to keep your credit history and downgrade the card. So, but try not to close old cards.
That's a great way out. So you don't have to close the account. You can just downgrade the card and therefore get rid of the annual fee. That's great advice. Uh, and another there's a myth I think that I would call it that's out there that you should keep a balance on your credit card, right? That like doing that, not paying off your bill in full, that'll improve your credit scores. Maybe talk a little bit about that and help bust the myth for us.
Yes, you said it. Bust the myth. I don't know who came up with this. I'm sure it was a credit card company who wanted to earn interest on everyone. You do not need to hold a balance. So the general thinking is that, okay, I need to just keep something on my card each month because that keeps the credit card companies happy, and my score will go up. No, you can pay off your bill in full every month and everybody's good. The thing that there's a little bit of truth to is if you have a card and you don't use it at all, like you make no charges on it, the credit card companies can close your card after 6 months. It's not common. It's more common during like periods of economic distress, when credit card companies are worried that people are going to go over, that they're going to start overcharging. Then they will reduce lines of credit. So I had a credit card once that had like $14,000 worth of credit. And I looked one day, this was a Capital One card. They're kind of notorious for this. I checked one day, I rarely used it. I checked one day during the pandemic and they had reduced it to like $2,500. So I was like, okay.
Big change.
So yeah, but I really didn't put very much on it. But I'm glad they didn't close it. And the reason they didn't close it, of course, is because I'll take some small recurring bill, Spotify, Netflix, Amazon Prime, whatever you want it to be. Um, I'll put that one bill on the credit card and then I'll set up automatic payments. So just like clockwork, I'll get charged, the monthly fee for Spotify, boom, pay it off. And then I never have to worry about that card. It sits in a drawer somewhere and it's earning, it's helping my credit history grow without stressing me out. Yeah.
So let's say someone's done, all the good things. They've had a good credit score for a while, but they really just want to get some of those advanced hacks. Like what are some advanced tips and tricks you have for people once they've established that good credit score?
So, well, when you're building your credit, there's a couple of things you want to do. So, becoming an authorized user. So, let's say you are a freshman in college, right? You have a couple of options. You could start from scratch when you want to get your first credit card, or you need to get a loan for a laptop or something, whatever it might be. Um, you can start from scratch, and that's going to get you an okay credit score. You're not going to be 800s, but you'll be okay. Or you can get added as an authorized user to a relative's card, like a parent, a guardian, aunt, uncle, someone who trusts you. But there's a secret to this, or it's not a secret. It's just like it just kind of makes sense. Whoever adds you to as an authorized user to the credit card, they don't have to send you the card. So if they're worried about, or if you're a parent and you're worried about your child like using the card, you can just tell the credit card companies, hey, I want to add this person as an authorized user. Here's their social security number, but send me the card. And so I actually did this with my little sisters. I put all of my little sisters onto my oldest credit card. And what it does is it copy pastes your credit history onto their credit report. So immediately my sisters had, like 14 years of history just because I put them on as an authorized user. But I'll put a little asterisk on that. Credit, or I should say, credit scoring companies like FICO, they know the difference between you being a regular user and you being an authorized user. So they don't give you quite as many points as you would normally get if it was your credit history. But it still helps. So that's a pro tip. Get added as an authorized user on someone's card before to help jumpstart your credit. Um, any questions about that before we move on to another pro
No, it's
tip?
great. I mean, giving the gift of credit there, and there's one other option that comes to mind, which is if you trust the person maybe a little bit, oftentimes the card companies will let you set a specific purchasing limit that person can have on the card. So I've done that for family members too. Just say they can spend no more than $500 or something like that, so it limits the risk.
Yep, that's right. And so this one, I would love to throw this one out there for people who are trying to improve their credit. Maybe they have a lot of credit card debt. You know, their credit utilization ratio might be high, and they're thinking, okay, I got to pay this down in order to improve my score. So this is a hack to be used with wisdom, with caution, but it definitely works. So if you have like 100% credit utilization ratio, let's say you've maxed out your card, there are two ways you could get that credit utilization ratio down. One is to pay off your balance below 30%, but something that's a little bit counterintuitive is that you could actually get another credit card.
Hmm.
And so let me explain how this works. If you have a credit card with a $1,000 limit, and you're using 1,000 of those dollars, your credit utilization ratio is 100%. But what if you add in a second card that has $1,000 limit, but you're only using $1,000? You just went from 100% credit utilization ratio to 50% because now you're only using $1,000 out of your $2,000 limit. I'm simplifying it a little bit. There's a little bit more to it than that in how they score it. But essentially, if you are feeling comfortable with yourself and you trust yourself, you can apply for another credit card, and that would actually help reduce your credit utilization ratio. But if you're the type of person, and everyone kind of knows who they are, if you're the type of person that says, "Oh my gosh, if I have another credit card, I'm just going to run up the bill," please do not use that hack. But if you're feeling responsible, that's another one that could work.
And that reminds me of another really great question, which is just we talked about like people who are at the higher end of the credit score and what they can do to help bring credit to other people. But how about people who are on they have bad credit, they've been through bankruptcies. One thing that I feel like I see a lot, and I'm always skeptical when I see something more in infomercials, is credit repair services or people who promise to get your credit up. Could you talk about that and just some of the pros and cons of using a service of that kind?
Yes. Okay. So first, the truth of it is, and I hate to say this, credit repair can work. It
Mhm.
definitely has worked for people that I know personally. So, but the way that it's done isn't always honest. So, and the way that they charge for it isn't always honest. Uh, so if you're going to, well, let me tell you how credit repair works. So this is what's actually going on behind the scenes. Um, America's great in that we have some really awesome laws that help protect consumers. One of those laws says if you ask a credit bureau for information, they have to give it. They have to give it to you, and if they don't have it, they have to, erase whatever negative impact that might have been related to. So, when you hire a credit repair agency, what they do is they write letters to the credit bureau, very specific letters. And there's a series of them, and they're asking for certain bits of information. Um, Often, if you pester the credit bureaus enough, they will just drop whatever it is you're asking them about. So, every month they'll send a letter. And they'll do this for like 6 to 12 months. And the credit bureau has to respond within 45 days to the inquiry. So it'll be like, hey, I is this my address that you have on file? Or can you prove that I opened this account and when I opened it? They'll ask really specific questions. Um, and I'd say that like half the time, if you have a late payment or something like that, it can actually get dropped. But the reason it's a little bit unethical is because sometimes whether you opened that account or not, and to ask the credit bureau to prove it and to say that it wasn't you, that's where it gets a little gray. But it does work. It can work. It doesn't work 100% of the time, but it does work often. Now, the predatory part of this whole thing is the way people charge. So if you decide to go that route, look for someone who charges for pay by removal. And what I mean by that is you only pay for the items that get removed. Um, there are other companies to juxtapose this, I'll give you the way the bad companies charge. They charge you on a monthly basis. They just say like, hey, you're gonna pay us this on a monthly basis. And then what they'll do is they'll be very slow in sending letters. I mean, they can control how long, how often the letters go out or how long it takes. And so people will be on retainer for like years and not realize it'll just be this $45 charge in the background. Those are the ones you want to avoid. You want the pay for removal, pay by removal. So if something gets removed, then I pay you. But yeah, it's a kind of a popular business within certain communities. So I definitely have experience there. Yeah.
Yeah, it seems like you're getting off on a technicality a little bit with the way they keep pestering the credit companies with those letters. But
Yes.
I'm
Well
glad to
said.
know that it can work. But just it's a great caution to be careful on how you're paying for it, so that you're only paying for when they actually perform on your behalf.
Yes.
And then anything else that we haven't talked about? Any closing thoughts on credit or the building of credit that you'd like to share with the community?
Yes. You are not your credit score. So I typically like I did a lot of financial coaching for people who went through something rough and they're rebuilding their score. And my goodness, the amount of just guilt and shame surrounding credit scores, it it could be debilitating for some people. And it would credit scores would be like this dirty little secret that no one would ever talk about. And um if someone has good credit, they will shout it from the rooftops as if like they are a really awesome person because they have great credit. But if someone has bad credit, they're just like shrinking in shame. So I want people to know you are not your credit score. It's just a number that is, the bank's gauge or a gauge of trying to decide whether you're credit worthy in this particular time period. But if you've gone through something rough, you can build back. For example, if you went through a bankruptcy, it's not the end of the world. There are very specific steps you can take to actually build your score back to a 700 within 2 to 3 years. Just like every 3 months, you're doing something to kind of build your score. So don't give up hope. Don't feel like all is lost. Do a little bit of education, and you'll see like wherever you are, you can find your way back. So that would be my kind of parting words. It's just you are not your score.
It's a great message. There's always hope out there, but it's not a number that we should be putting front and center all the time.
Yeah.
Well, that's really great. We really appreciate your expertise, DJ. It's wonderful to have you on the team. Wonderful to have somebody with your unique experience in credit and travel, and we love talking about this stuff. So thanks for sharing that today.
Thank you again for having me. This was a blast. Appreciate it.